Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes guiding markets at the moment. That is both technical themes and also fundamentals. Whilst I'll just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next half hour, 40 minutes or so. Certainly be focusing on where markets are currently, obviously with the news over the weekend and on Friday, of course, of this banking crisis really that we're seeing now. Massive moves in bond markets. Obviously, risk markets have sold off. So we'll just touch on that, of course, look at that insofar as the bond market's repricing as well. We'll just see some of these moves in 2-year Treasury yields, which are some of the biggest ever seen, actually. We'll focus on that firstly. We'll also look at the impact on FX, of course, on the dollar and also stock markets. We'll technically look at those as well. So look at the charts for the SPX, the Dow, NASDAQ, as well as the DAX and the FTSE worth looking at, of course, in Europe. We'll then briefly review the data from Friday, non-farm payrolls, of course, still important data to look at and just check for what's happening in the labor market, of course, in the US, before then focusing on the key events for this week. So that is the US CPI data. We'll look at the dollar in that as well, the DXY, before then looking at the ECB meeting, of course, on Thursday. And then just before that, actually, we have some UK data and the UK budget on Wednesday. And then hopefully, if we have time, we'll look at gold as well, because obviously that is a safe haven asset, which is looking pretty strong at the moment and over the last couple of the days. Okay, firstly then, just pointing you to some of these massive moves in bond markets, and that means obviously repricing for central banks, for the Fed, ECB, Bank of England. I'll go through that shortly, but just general sort of recap, of course, over the weekend, US policymakers really took measures to try and restore confidence, halt the deposit run in parts of the US banking system. Of course, there's still risks of contagion that we're now seeing in European hours. Really interesting as well as US traders get to their desks. Some of the moves, some of the relief rally that we saw with some of those measures enacted by the US overnight, they're sort of being reined in slightly. Certainly then we've had the collapse of SVB, so Silicon Valley Bank. But certainly as well, that uncertainty still not gone away. US regional bank shares getting hit pre-market. And then we've seen nervousness follow through to some of the European banking stocks as well. As I say, massive, dramatic repricing really in the Fed curve. The US yield, so the US Treasury 2-year yield, suffering its biggest 2-day drop since 1987. You can just see on this chart here from Bloomberg some of the other historic days where we've seen sort of bigger drops, if you like, and they are basically in the 08 GFC crisis and then Black Monday post 9/11. So you get a kind of guide of how big some of these moves are. That's in the 2-year Treasury yield, which maps, of course, Fed funds rate most closely. We've had another bank, actually, Signature Bank in New York. Actually, that's closed down late last night as well. So the risks really may not have been preempted, judging from price action, of course, this morning. And as I say, that near-term relief where stocks and futures, actually US futures were bid, actually. I think at one point S&P futures were bid up over 1%, actually, near 1.5%, actually. So regaining the losses from Friday, but those have all been pulled back now, and S&P futures just marginally in the green, I think. NASDAQ slightly better, but those gains have been pulled back, as I say. We've had then the announcement of a lending program and other new measures by the Fed and by the regulator, trying to put depositor concerns at ease. And certainly then, as I say, we've had smaller regional banks in the US getting hit, and there's definitely sort of panic and uncertainty in the air. I think interesting really, or to point out lessons from previous crises, so the Euro crisis 2011, GFC in 08, kind of you get these early cracks, you get the rescue attempts by regulators, and sometimes of course we've seen that is not enough initially to sort of vacuum these events, if you like. But certainly as well, I have to caveat everything with the fact that, you know, we do not have a lot of information. We're second guessing really, and just trying to even put this webinar together. Really, prices are changing, of course, all the time. It's exceptionally volatile, really, and we should take note of that. And of course, this webinar as well. And I think probably I'll be saying constantly about how things can change. And we've seen that over the course of the last few hours, having got in early this morning and seeing how markets have reacted. I guess a couple of things to watch initially. President Biden, he's speaking in a few hours' time, I think at 1 o'clock. So actually in less than an hour, actually now. I think that was the last time I saw him confirmed. So 9 a.m. Eastern time, 1 p.m. GMT, that is. So he's going to be speaking on obviously the SVB situation at the moment, and his administration will be briefing Congress apparently as well. I think the focus will be on any other measures announced to strengthen the oversight, obviously tighten regulations, then to avoid further banking sector stress. At the same time as obviously the Fed is trying to continue its inflation fight. Then also, of course, things to watch are the monetary policy response and obviously this direction of yields, really. The risk, obviously, of a financial crisis further complicating, really, the monetary policy response function in the US. Markets went from pricing in a 25 basis point rate hike for the March meeting to 50 basis points after Powell's testimony last week, where he sort of took a hawkish pivot, if you like. And then they've come back to sort of 25 basis points now because of this risk of contagion in the financial sector. I think terminal rates pricing actually has gone down from near 5.8% even at the peak last week. Now that's below 5%, around 4.8%, I think, the last pricing. Some banks, I think Goldman Sachs now calling for the Fed to pause in March, really to reassess the impacts of their policy tightening. There's sort of speculation about how quickly, obviously, how aggressive the Fed has been in policy tightening, and whether then we've said it consistently actually over the last few months. Of course, they need to rein in demand, and then that takes on the guise where the system or something in the system breaks, and potentially now that is what we're seeing with some of these bond portfolios in some of these smaller banks having to be mark to market, if you like, and those are then taking on losses, and then banks needing to shore up its capital or their capital for sure. That's kind of a very brief synopsis really of what's happening. Potentially things are breaking, and markets are obviously reacting and reining in all these or the aggressive rate hikes going forward. I think there's even now rate cuts priced in to the back end of this year, around 40 to 50 basis points of rate cuts priced in towards the end of this year. So really interesting, massive market moves, as I say, in bond markets, and then that's feeding through into other markets as well. I think, yes, kind of further out, you've got to think if a crisis is averted, potentially then there is, of course, damage to the real economy. Banks, of course, will think twice about lending, if you like. Consumers think twice about borrowing, and then confidence obviously will be affected further out and fall further potentially. For FX, we've introduced this chart over the last few weeks now. You can see on the left-hand side, that was last week's year-to-date performance in the major currencies. On the right-hand side, that is just a snapshot from a few minutes ago. So we can see, of course, this is the first major US financial crisis since 2008. The collapse of SVB, so Silicon Valley Bank, second biggest bank failure in US history actually now. And that has really caused safe haven bids. So you can see the Swiss franc, of course, now assuming the best performing major currency year to date. You can also see, whereas the yen was suffering obviously just a week ago, now those losses really pulled back. So it's those two currencies really which are outperforming at the moment, the Swiss franc and the Japanese yen. I think we did mention the Swiss franc a couple of weeks ago. Really, that's been the outperformer generally over the last few days, aside from, in a way, from this safe haven role, which is obviously important. But we did mention, I think, the Swiss National Bank really at the moment has the franc's back, if you like. It's prepared to sell FX reserves to prevent weakness in the franc, as it uses the exchange rate as part of its monetary policy regime. So that was sort of in the background, and then obviously we've had this safe haven buying of the franc, of the yen. For equities, let me just switch to a couple of charts. Firstly, well, actually, we'll just look at this 2-year yield. You can just see this is, yeah, we don't get caught too much in some of these charts, but this is obviously just showing you this complete collapse from where 2-year yields were above 5%, now sort of 4.17%. That, as we've said, pointed out, one of the biggest changes in yields over 2 days ever, basically. And then the 10-year, you can see here above 4%, which was always a key psychological level. We pointed that out over the last few weeks. And then that collapse in 10-year yields. And you can see now, interesting, right on the 200-day moving average now. This is the 10-year US Treasury yield. You can see it acted as strong support really this year already, and we've just touched that and just sort of bounced off it. That's at just below 3.5%. So some nice round numbers really to point out, and just to probably just keep your eye on going forward as this sort of policy response and crisis develop. Just on equities then, of course, you can see these are the futures just going into the red now, after sort of pointing up, as I said, over 1.5%. You can see just there, the top of that candle, nearly reining in all or getting back to Friday's top. But now we've turned red again, sadly. A lot of banks in Europe down. Credit Suisse, I think, is down over 10%. Most indices now, European indices, just having a look, down sort of 2 to 3% lower. If you think about equities, then consider the ripple effects really of the banking fallout in stocks. I think you've got this continuous disclosure, it's called, obligations for listed companies to disclose their exposure to SVB, to Signature Bank as well, that other bank that's been closed down, and their relationship over the coming days that has to be disclosed. And then also, I guess you've got to consider the market will be searching for opportunities really to de-risk. So potentially selling out of firms that are prone to concentration risk, or potentially those under financial duress, of course. So that may include, and Credit Suisse, probably a good example, institutions that have concentrated or not diversified clients' books and revenue streams. And there's then also those companies that have lent money to high-risk tech companies potentially, and or startups as well. So just sort of technicals, on the technicals then for charts, we'll just pull up the S&P 500. This is the cash, so not the futures. If we just go to the weekly, you can see really we plunged through, so a fib level of the 2022 decline, the 38.2, that is, so a major fib level at 39.84. You can see there sort of oscillated around that, and then last week moved sharply lower. We also moved below the 50-week moving average. That's that light blue line at just below 4,000, obviously moving down below that psychological level 4,000, and then also trend line resistance slash support. You can see that long-term trend line, and we moved below that. Interestingly as well, blow this up, it's a bearish engulfing candle. So just this whole week's candle engulfs, if you like, the previous week's high low range, and you can see really very bearish, really closing on its lows. That's on the weekly chart. On the daily, you can see them moving below the 200-day moving average at 39.40, below the 100-day moving average 39.45. So that's certainly strong resistance now above. And then that trend line you can see around 3,900, really just above there as well. So that's the S&P looking rather bearish. You can see on the daily RSI we haven't really got oversold still, so probably next target is 3,800, just above that, which is the December sort of range. You can see there we oscillated around for quite a few days, so that's probably next strong support for the S&P 500. NASDAQ, you can see the futures market. Let's just have a look at that. You can see it's pulled back there on that candle, and we're just sort of in the green, up 0.4% or so. But if we go to the cash market, you can see the close again on the weekly, a bearish engulfing candle, drop below the 50-week moving average at 12,125. This is NASDAQ 100. We're just approaching now interesting fib level. That's the halfway point of, well, the big rally from the 2020 lows, actually. So the halfway point at 11,768, and then also the 200-week moving average at 11,702. So should be strong support there, you would think, on the weekly. If we just go to the daily, you've got the 200-day moving average now. We just moved below that, 11,903. And just sort of hit a sort of lows not seen since sort of back end of January. You've got the fib level there as well in the NASDAQ. For the Dow, again, bearish engulfing candle, big one there on the Dow. Sorry, just checking something out there. Yeah, so big bearish engulfing candle below the 50-week moving average as well at 32,579. I've drawn some sort of nearer fib levels in here. That's from the last year's decline. You can see we've gone through the the halfway point, the 50% mark of that, which is around 32,834, I think it was. So really, potentially the 200-week moving average as support just above 30,000, 30,664. Otherwise, on the daily, yeah, again, you've got we're below the 200-day moving average at 32,392. Acted as sort of support really previously in December. Didn't quite get there, but now we've closed below that. So really interesting point for the Dow. If we just move to some of the European indexes, we can see the DAX. We thought, well, we'd have to close above the February high really on a weekly basis, and we didn't do that. The February high was at 15,656 to sort of push above. We haven't been able to do that. You can see them. We've broken this long-term trend line, if you like, and sort of that low from the start of March, 15,145. Also the 50-day moving average, that light blue line. So we're probably coming back potentially, if we keep this bearish trend. First support is probably 14,901, and then we get this spike high from mid-December at 14,677. That's in the DAX, and then UK, big tumble, 3 days really. We moved down below 7,689, which was some of these previous highs there. You can see, and now we're on the 100-day moving average 7,595 potentially, which sort of tallies with these previous highs in December. Okay, those are some of the technicals. Let's now look at just non-farm payrolls quickly. There's a brief synopsis, a summary, if you like, of all the main figures. Headline obviously rose by 311,000, more than expected, but less than obviously the January blowout of 517. If you remember, of course, that was actually revised slightly lower marginally, 504 actually. Kind of a mixed bag, some economists saying, because obviously we got still very strong job gains. We'll bring up a couple of charts just to highlight that. So we've had strong employment growth, but then wage growth, this number 0.2%, that cooled from 0.3%. And then the unemployment rate as well ticked up to 3.6 from 3.4 here. 3.4 in January. That was kind of because of labour force participation improving. So the data, if we just step back before obviously the SVB blowout, kind of muddied the water for the Fed. Anyway, this data really, because job growth is still strong, I've highlighted here 350,000 job gains over the last 3 months, really still high. Small revisions to the previous 2 months and not massive revisions that some people thought we might see, seasonal adjustments and so forth. And after the data release, well, we were still pricing in around 37 basis points or so for the March hike. Obviously, that now, since then, that's all changed, and really added this sort of data mixed bag slightly, but still strong job gains. Let me just show you, just highlight some of these job gains anyway, because just in case, obviously, we get some turnaround later on in the week, potentially to this the situation at the moment. But you can see here still relatively strong, the 3-month trailing average there. You can see still, as I say, around 350 mark or so. And then this is a chart just showing you really how sort of recent job growth compares to recent years. The economy added 4.34 million jobs there actually over 12 months to February 2023. That's down from the prior 12 months. You can see there, obviously blockbuster gains before that, but growth over the years faster than what we've seen to February during this whole recovery from 2008. So still very strong job gains. Okay, let's now go to this week's main events. So we've got US CPI, the main event, which is tomorrow here. We've got a graphic with just the main numbers and the expectations for those. Obviously, this is the next big test for the Fed rate hike path. And certainly if it's still evident that inflation risks remain prominent, and as well, if the Fed can convince markets that financial risks are sort of contained over the next sort of few days at least, then yields potentially they could reverse sharply higher once again, and then the dollar could strengthen. You've got the main numbers here. I guess the big test after last month's print obviously reversed that kind of disinflation narrative, if you like. If you remember, we sort of popped up from 6.2 to 6.4% in January. The headline, that's now expected to fall back to 6% from the previous 6.4. Core month on month actually expected to rise 0.4, so that 1/10 lower than the 0.5% or so expected sorry, the 0.5% was in January. So just a slight pullback in that pace as well. And then you've got the core rate. So that strips out, of course, the volatile food and energy prices, or that element. That's for the core is expected to fall 0.1 from 5.6% in January. And then the core month on month expected to match the 0.4% seen in January as well. So generally, if we do get this sort of picture as consensus thinks, then inflation certainly remains stubbornly high. And then especially after kind of the tough weather conditions seen in California, the risks potentially, if the crisis sort of abates slightly, then yes, we do get hikes going forward, although of course the meeting is next week. Other data to note this week, just to highlight, retail sales and PPI, both expected to show modest cooling actually, but still remain high sort of PPI prices anyway. Expected 0.3% month-on-month rise from previous 0.7, year-on-year 5.4% from the previous 6%. And then retail sales expected to cool from the big jump in January of 3%. That was essentially due to warmer weather. I think the reading now is for a 0.2% month-on-month increase. So really, yes, as I said, can't reiterate enough, all about the contagion fears, and then whether we do get a change in any of this this big repricing of the Fed's rate hikes that are currently priced in. I was going to show you, I was going to move to the ECB, but just before that, actually, let's just show you what we look at a lot is the CME Fed Watch tool. So that just shows you Fed pricing really. Let me just refresh now because it's been changing a lot. So it's sort of 70-30 now. So just to recap, we're currently at 4.5 to 4.75. So there's a 67% chance we have a 25 basis point hike next week. 33% chance that there is no hike at all. And if we just scroll down, you can see on Friday, there was actually 0% chance that we would not move next week. 60% chance that we would move by 25 and a 40% chance that we would move by 50. So you can just see there those sort of moves in those Treasury yields being reflected in Fed funds, and they're sort of good, really good representation really, and hopefully that's clear for you guys to see as well. Just then also then looking at how that's impacting the dollar DXY charts, you can see sort of dollar just rolling over from those highs at 105.88 last Wednesday. You can see the big push on Tuesday after the sort of hawkish pivot by Fed Chair Powell at his semi-annual testimony, but then we've just rolled over. We've rolled now below the 100-day moving average. That's at 105.07, but we're still sort of being supported by the what is that? The January 27 high. I've kept it in there. That's at 103.82, and then below there the sort of pandemic spike highs at 102.99. So first level of support is 103.82. We bounced off that, but we're sort of capped potentially by the 105.07. That's the 100-day moving average. That's on the DXY. Okay, just moving to then the ECB. Again, graphic showing a load of numbers, but sort of what's expected. Will of course be challenging, but I think current pricing last I saw was, well, I've got a half percentage point rate hike still expected. I think it's now 39 basis points priced in by markets, so that's come down from above 50. I think so. Still, really, a sort of half point rate hike expected, as I say, on Thursday. Focus will be on the guidance. If they do obviously continue with that 50 basis point hike, guidance will be key for interest rates going forward, as well as, of course, on the comments around the risks of this financial contagion spreading. Recent data has surprised on the upside in core inflation. Certainly, we've talked about that, and that had prompted ECB pricing to shift to a terminal rate around sort of 4.5% or so, I think. But that, as I say, when we had 1.5 basis points of rate hikes priced in, sorry, it was a 4% terminal rate priced in by July. That's now pulled back to around 3.5% with all these big moves in bond markets. Certainly, if ECB stays away from guiding for another hike, big hike in May, for example, then probably it would show you just the amount of concern about this financial contagion. We do get the latest ECB staff projections, actually, and obviously inflation forecasts will be key. I think core inflation expectations likely to be revised higher for this year, but then lower further out, so out into 2024, 2025. We also get growth estimates from the ECB, new projections, and they would be important really to see if the if the ECB sticks to its previous view that the economy will return to pre-pandemic growth rates already in the second half of this year. If they do so, then markets will certainly then price back some of these rate hikes seen over the last few days, of course, and that would probably give a boost to the euro. We've highlighted actually in our weekly commentary, if any of you guys read that on the website, just this general battle between hawks and doves on the Governing Council at the ECB. That is sure to intensify if we sort of ride out some of this contagion. And President Lagarde, you've got to think, will have a tough job unifying really both parts of the Governing Council and then selling that message to markets. She has probably ECB watchers really think she's kind of struggled with that message after at the press conference, so after the rate decision. So we'll be all eyes on that, of course, on Thursday afternoon. Expect volatility, of course, and then we kind of expect ECB officials to come out on the wires after the meeting, really, to back up their message, at least anyway, whether they're on the hawkish side or the dovish side. Let me just show you, let's just have a look at euro dollar. So interesting, yeah, this dramatic repricing, obviously, of the policy curves, really. That's narrowed rates between the euro sort of fixed income markets, the swap rates, if you like, and the dollar swap rates as well. I think they've got to the narrowest since around October 2021, that is now. That's certainly a euro dollar positive. So really kind of if you think that well, if we don't get a sort of rally in US banking stocks, if there's not a big shoring up by US authorities, then potentially the dollar will still suffer. Euro potentially benefit from that. You can see this pulling back actually in today's candle there, where we went above the 50-day moving average at 107.20, high of 107.37 earlier today, and we've pulled back below 107 now, and below Friday's high as well. So interesting moves in euro dollar. You have got strong support, it looks like, from the February lows around sort of 105.37. That sort of tallies with the 100-day moving average, that grey line at 105.41. So you'd expect strong support there. We've actually got in, what do we got here? Yeah, 38.2 fib level of the big move from the 2021 high. So that 38.2 fib level comes in at 106.10. So that may act as some support as well, or we may at least trade around that, which we have done obviously in the last couple of weeks anyway. So that's euro dollar. UK, let's just touch on the UK. We'll go to cable, but yeah, just touching on what's happening. We have the spring budget that's delivered by Chancellor Jeremy Hunt on Wednesday. Kind of a key watch, obviously, after the turmoil in September, when obviously Prime Minister Truss and Kwasi Kwarteng unveiled those unfunded, lavish tax cuts, if you like, really whacked markets. Expectations for Hunt this time to prioritise keeping public finances steady and announce less near-term borrowing, but only a marginally improved medium-term fiscal outlook, really. Lower energy prices will certainly boost the short-term growth outlook, potentially helping those recession fears recede, although longer-term growth may remain marred with weak productivity growth and also low labour force participation. We do get more labour market data as well. That's released tomorrow. Markets really scrambling around, trying to gauge how much more room there is for the Bank of England to tighten further. Their meeting is next week. Let's not forget. I think there's now around a 33% chance or so that actually the Bank of England hold rates at 4% next Thursday. Markets really expected a 25 basis point hike, but that has obviously been pulled back massively now. Just thinking about the UK data, I think just touch on that. Unemployment expected to rise to 3.8% from 3.7% previously. The headline jobs growth likely to ease. So as I say, markets all over the shop really trying to price in the Bank of England, as they are with all the other central banks. But at the moment, kind of, around a 30. I think that's jumped up now to, just looking at it, 38% or so chance of no hike at the meeting next Thursday. Cable kind of beholden to the dollar, really. So dollar weakness seen cable, so that's sterling against the dollar, really sort of bounced quite strongly, really, from the 118.41 support we had from that year-to-date low start of January. Was looking kind of bleak after Powell's pivot, but we've seen, decent gains. Also above the 200-day moving average, which is that dark black line. That's now at 118.95, has sort of acted as decent support, really. So broken above that short-term trend line resistance as well, kind of very initial near-term possibly support, and then you've got the 100-day moving average at 120.23 as well. So that is cable. I said we'd touch on gold. There's still a lot of you tuned in, so let's look at gold as well. Always a favourite, making sort of fresh strides higher, really, as a safe, really strong safe haven demand, of course. On the fallout, and obviously contagion as well. Well, what are the drivers of gold, or have been recently over the last few months? Obviously the dollar, so that's turned lower, and then obviously Treasury yields going higher, and that they've seen massive drops. So obviously helping gold, precious metal, haven bids. And just on the technical side, then you could see sort of probably small support by previous lows anyway. February lows around sort of 1800, just above that. So a nice round number, and we just pushed up now above the 50-day moving average at 1872, and also, of course, those previous highs in March around 1858. So we're now back to a fib level. That fib level is from the sort of spike high in 2022 down to the lows seen last year. So we're now touching sort of the 61.8 fib level at 1896. Interesting to see whether we can get above that or not. And you can see there on the weekly, I'm just trying to track some levels above there, really. We probably go to this I'd pick out that weekly high from the May 2021 at 1916, a possible further upside target. Okay, hope that's been useful for you guys. Obviously, a sort of financial crisis now added to everything else that we've been trying to talk about over the last few weeks and months. These key themes sort of jolted by what we're seeing from Friday. A lot of opportunity, but also a lot of volatility. So just take care out there, and we shall speak to you same time next week.